So
Fantastic.
welcome everybody. I'm so excited for this session on digital health IPOs. And just so you all know, Stephanie and I did not coordinate outfits, but we are wearing green, which I guess is the color of money. So it's
It's
strangely
a bull
appropriate.
market color. If you're on Bloomberg and you're seeing that color, things are not going well. So here's hoping
So
better
this
things for
is this is an
IPOs.
optimistic choice that was not pre-discussed. And so I will quickly introduce myself. I'm Chrissy Farr. I run a digital health media company called Second Opinion and a fund called Scrub Capital. And then I'm also an advisor to companies in the space. Stephanie, I'm going to let you introduce yourself.
Yeah, sure. Stephanie Davis. I've been a long-term health tech research analyst. I have been following the space since meaningful use, which means I have a very good dermatologist. And I am currently advising companies as well, and I am operating curious. So you'll see seeing a lot more of me. Thank you for having me on the program, Chrissy.
I'm so excited that you are here for what is now, I think, our like third or fourth of these. So
Love
it's
it.
definitely a work in progress being doing these on LinkedIn, but I love how interactive they are. So everybody who has comments, please feel free to share them. And we would love to hear from you throughout.
Yeah.
So Stephanie, so much to talk about in digital health, so many IPOs going on at this very moment in time. I think even today I saw a report in Business Insider about a company called Zealous that may go public.
Know them well.
Okay,
Think
well,
they
I had never
should.
heard of them, and I thought I understood kind of what was going on in the space, so that was a little bit of a moment. But I saw they were in the payments area, so let's start there. Like, what is with this trend of kind of under the radar companies going public, while the ones that we all expect to see stay private? Zealous, I think, is a good example. Frisia is another one that I would say is under the radar. Waystar. So what's going on with this one, Zealous?
Well, look, here's what I'd say as a background before we get into Zealous itself. I think if you look at every subsector of all the different public companies, payments is actually an incredibly successful area of the world, and it's an area of the world that has one of the highest margins. So as long as we are in a world where we care about margins for IPOs, and this is something where you either need a margin trajectory or you need a very healthy kind of base margin that investors want to buy in for the story, I think we're going to see a lot more payments assets become pretty attractive in the space.
And
And
this is in revenue cycle on it sounds like on the front end, right?
I think of them as a broader payments play, right? They have a part of their business that looks a little bit like Claritiv or Multiplan, but then they have a pure play payments business that could be pretty compelling to investors that are looking for something more diversified.
So who do they compete with?
From the public space, you could see them a little bit with the Fresias and the Waystars of the world.
Okay, so it's another one that's in the same bucket. Under
Mhm.
the radar in the payments area. It's echoes what we're seeing in the private markets too, with all this VC money going into payments and then revenue cycle writ large. I think a lot of that can be buoyed by enthusiasm for AI. I've had some founders tell me that they think that it's revenue cycle that's going to be the first world-class application of AI in healthcare. Do you agree?
Well, if you think about revenue cycle management, look outside of healthcare and who does it, right? Like Cognizant with their TriZetto acquisition has it. It's at its core a BPO business, business process outsourcing, where you have a call center and maybe you're near shore, maybe you're onshore, offshore, but it's a lot of bodies. And we think about the applications of Gen AI and where it could go so successfully, it's removing some of those bodies and automating those processes. So RevCycle, I think there's both a giant opportunity and there's a giant potential for disruption in that space, as historically they were paid on friction, maybe they should be paid on the removal of that friction.
I completely agree. And I've had some people tell me within the rev cycle universe recently that the best case scenario is that they would at some point lose their jobs because they are building themselves out of existence, which I think is both noble and potentially somewhat of an existential threat for the space. But it does leave big opportunities for a lot of these PE-backed players that I think are more end to end in
100%.
their orientation.
And I think we're going to see job creation more on the Gen AI side, while some of the more, kind of frustrating manual processes in healthcare will go away, which is a benefit. We want those frustrating manual processes go away because it'll make the friction for the patient go away a bit as well. But I think about revenue cycle management, like there's a huge opportunity where they can change a lot of those friction points and not get paid for having to go and be a part of those friction points.
Here's to that. I am in favor of any company that can remove billions of dollars of administrative waste from the system. So I would love to
Yeah.
see that happen.
Count me in.
So I'm going to shift focus a little bit, Stephanie, and talk about some of the more traditional digital health players that tend to be quite heavy on services, may not be capable of the kind of growth that we would expect to see with a traditional tech business, say in areas like SaaS. Some of these companies should not be growing to that in the same way. Like something would be very wrong if they were. And yet there are decent businesses in tech-enabled services, and we've
Of
seen some of
course.
them go out. Look at Hinge Health. So tell me a little bit about investor appetite right now in the public markets for these tech-enabled services businesses, and then what are expectations around growth and profitability looking like right now? Like, what is more important?
Look, I would first say the idea of health tech being SaaS ever, I've always thought was kind of crazy. Like I know a lot of people look at health tech and they say, "Oh, this is like the software sector into healthcare." No, it's not. It's a lot like the IT services sector into healthcare because you're always going to have a human component. You're always going to have some level of hand holding. So the idea of health tech as anything but platform as a service is insanity. So now that that rant's over, um, I do think there's a huge opportunity in digital health. It's different than it was before. When I was covering the space and digital health, like we didn't call it digital health, we just called it, HCIT, but the newer part of the sector. I think we looked at and we said, what could the business model be? What could the terminal margins look like? What could the growth be? Um, we got a lot of answers with that during the pandemic, right? Telemedicine, the greatest example of digital health, really came into its level of maturity that we would see without a pandemic maybe 10 years from now. There is an appetite for a lot more digital health disruptors. I don't think that business is going away. I think what we realize is you need to have it in very recurring areas of need and spend. That's why we've seen Hinge and Omada go out. I think diabetes, weight management, and MSK, two huge pockets of spend and recurring huge pockets of spend. And the other thing we need to consider, and I think a lot of folks don't when they're looking at the comps, is where they are in the maturity curve, right? Omada and Hinge are earlier in their adoption life cycle, so they're still seeing this hyper growth, and they should see that hyper growth. Like I remember when Teladoc was a crazy grower, so we shouldn't be comping it to someone that's at the end stage of their maturity. I argued when I was still covering ads, I was like, look, Omada should trade where Teladoc was trading around 5 times revenues when its growth was still in that stage. No surprise, that's where it trades, right?
That was definitely a really good intuition. And by the way, guys, if you have questions, please drop them in. I have
Yeah,
so many
toss
more
them
for
in.
Stephanie,
Happy to
but would
talk.
love to answer some of yours as well. So what are you seeing as some of the big potential issues with some of these early digital health IPOs? I think one of the things that's been commented on quite a bit is just too much revenue concentration, a lack of customer diversification, being another one. And then, in some cases, I think a struggle to move into other forms of payers. For instance, Omada's never really moved into Medicare, neither has Hinge, and that was part of the plan in the early days of the business. It's left them in the employer market and potentially with payers. But then you get a lot of pricing pressure with just so much competition that we already see in those areas. So tell me if you have any further thoughts on how kind of normal those things are. Like, are these just things that you would expect to see when a company is kind of a baby public company, they
Yeah.
just went public, or are these things that you view as existential long-term threats if they can't be solved?
Customer concentration risk. Let's address that first. It's always something that investors will be concerned about. And I think after seeing some large customer attrition with Accolade, it's maybe a little bit more of a pain point than a lot of folks had before. I think naturally, as these businesses grow and they're no longer baby public companies, they become, more adult public companies. They're also seeing more diversification of that. When you really look at kind of the life cycle of how digital health grows, and I think this is important to think about, digital health in its early stages always is employer facing. Teladoc was an employer-facing name for the longest time. It only evolved more into the payer channel once, employers tend to be faster adopting and quicker to go and embrace these changes. Once they saw a lot of folks embrace these changes and start to use telemedicine, that's when the payers really embraced it as well. Um, I remember it was a few years as a public company before we really started hearing about traction in Teladoc's payer contracts, and I wouldn't be surprised if we saw that as well. MSK is a huge pocket of spend, not just for employers, it's for payers too. And we're probably going to see it go in that direction. It just takes time. It's like I said, you can't compare Teladoc today, a fully mature adult business, arguably not even digital health growth, now a GARP business, growth at a reasonable price. It needs to go and kind of mature to that life cycle and say this is the same as a growth company just because they sell to the same end market.
So if you're one of the ones that's just kind of waiting in the wings right now, and these are, a lot of these businesses have real revenue. Like we're talking hundreds of millions, if not kind of in the low billions in revenue, but not yet publicly traded, perhaps watching to see how it goes with Hinge and Omada.
Mhm.
What do you think these businesses should be doing to prime the market? And do you think that they should be emphasizing any differentiations with the ones that have gone public that would maybe increase just interest in these stocks? Or do you think it's better to kind of draw some comparisons that we start to build up in the minds of investors, just to give them a sense of what digital health even is?
So I think in the early days of digital health, it was kind of a weird thought experiment in order to find your comp set because there were no true comps. You had to think, what are your comps across different end markets, different industries? Now, like if I were working on one of these digital health IPOs, I would say you should really think about where these are in the life cycle because you can easily point to many of the digital health names earlier in their life cycle and their adoption cycle and look at a very different multiple than some of the public digital health names today. But the market gets there, right? The Mr. Market answers a lot of questions, and you've seen that Hinge and Omada have been valued that way. It wouldn't be hard to point to that as well for some of these digital health names. What I would say, and I think is an underutilized tool, talk about cohort unit economics. Everyone wants to know what your terminal margin is. A lot of folks don't really know how to get there. And if you can say, you know what, our company-wide margin is this, but for the cohort that started with us 5 years ago, our unit economics are this. So we have a very clear path to profitability. Man, that would de-risk a lot.
Yeah, that makes sense. What about just like even the basics of like, do public investors even understand digital health for what it truly is and what makes it different? Do we need some education just around that? Like, does Wall Street still perceive these businesses as basically being just like any other tech company, but in healthcare, or kind of like a services company with a bit more tech? Or is there an understanding of the nuances?
I think a lot of folks get what digital health is now. First of all, we would be so lucky if investors viewed this as just another tech company in healthcare. Like, I would love that. But I think a lot of folks are looking at it in the realm of a lot of companies that haven't had the most successful public runs. And so that is more of the battle that you're going to have. And talking about the unit economics, talking about kind of the longer term trajectory that can help combat some of these fears. There's also like there's a lot of things that are just good hygiene before someone comes public, right? You should be getting out there and talking to investors well ahead of coming public so they can get a feel for management. I know a lot of companies didn't do that historically. Don't make that mistake. You should make sure all the crazy investments you want to make for your longer term roadmap, make them now because once you're public, investors really like a more linear trajectory for margin expansion. If you actually want to start with a much worse margin by investing all upfront, that's not the worst idea.
That's interesting. So maybe let's go specific. Like if you are a Lyra, if you are a Sword Health,
Yeah.
what should you be doing in the next, say, year to year and a half? Like it sounds like M&A might be a good thing, just to kind of do that now while you're still private, while you can. What I'm curious, like what else? And then what kinds of M&A do you think some of these companies should be doing?
I think we're also going to see a lot of movement and change in this space, especially when I think of Sword, because you have a huge opportunity with Gen AI. And as a result, it might make sense to make some of these acquisitions that might have a pretty hefty price tag upfront now, make your investments upfront now, and then you'll have a much more linear trajectory once you're starting to come out or you're thinking of coming out. I also think to the extent that some of these stories are evolving a little bit, it might be time to go and message to the market how those stories are evolving. Sword doesn't want to be just an MSK player when they grow up. Make sure folks don't say this is just an MSK player, and then you battle that perception when you're trying to go public.
Stephanie, we've had a question come in from Samir, which I think is a great one, that like
Samir!
we
Love it.
see some disconnect right now between private market valuations. You saw that even with the two examples of the companies that went out, especially in the case of Hinge, where some of the Series D and beyond investors didn't do so well on that one. The early investors did fine though, but a lot of that comes down to
Yeah.
valuation and the difference between what the public markets are willing to say the valuation should be versus the private markets. So should founders be getting ahead of this by even choosing more conservative valuation so you do see that trajectory? Or do you think just take the most money at the highest price that you can possibly get? And what about the VCs? Like, how do they avoid making some of these mistakes? And maybe it's just benefit of hindsight. Like, some of these companies may have looked very different at the time that they were raising. There was far less pricing pressure at that
Yeah.
point in time, for instance. But, you can start to kind of read some of the writing on the wall and see that there is a lot of good competition out there and that some of these things may happen. And so, I think trying to be conservative at the same time as there's also a lot of competition for these deals. But any thoughts on that of just like, how do you make sure those valuations are good in the private markets moving into public?
Look, I would say that's a push-pull issue. You have two problems here. You have AUM, and you also have VC needs to get deals done. If you have more AUM dedicated to the private side of health tech, and believe me, like having been at SVB, there are more dollars for private health tech companies than there are public markets investors willing to jump at health tech companies, because most health tech companies have underperformed the S&P, excluding, this is the opposite of a fun fact. If you exclude all of the different SPACs, you just take health tech companies that had an IPO for the past 15 years, and you see their trajectory and how they've had like annualized returns. On average, you've underperformed the S&P by 5 to 6 points,
That's
which
really
isn't great.
depressing.
And that includes takeouts. That includes, like if you got in Cerner in 1986 when they first came public, like this includes everything. And if you include the SPACs, you've actually had a negative annualized return.
Ugh,
And
this
you've
is
underperformed
depressing.
the S&P by about 15 points. So yeah, like public markets doesn't have as many dollars available to invest in digital health. So when you have a lower AUM investing into a smaller amount of assets, but maybe more assets that are out there, yeah, you're probably going to get a worse valuation. Flip side, if I'm a VC and there are so many private market dollars competing to get into this company, I would rather be involved in the company than not if I really believe it's a winner, because the valuation could be funky at the IPO. It could eventually trade up to it. The company could scale up to a point where even with a lower multiple, it could get to that kind of valuation. So it's more a question of like assets that you truly want to be in versus doing a quicker trade, which I'd argue you shouldn't be doing in the private market space at all. Will you have a step down when you go into the public markets? Yeah, I mean, like, especially invested in 2020, it's not a great time to
No,
say
none of
like
those
2020
vintages
valuations are
it's not a
getting
good
here.
vintage.
Yeah,
Yeah.
not a good
And
vintage.
it makes me wonder a little bit if some of the venture funds with the larger AUMs will continue to want to invest in healthcare. If you can also put your money into AI or fintech or whatever else,
Yeah,
like will health tech continue to be an area that they believe they can return funds by investing in? I think it's a question I've been grappling with for a while. And yeah, I mean, do you have thoughts on it?
that's how bad the pandemic hurt you, huh? The post-pandemic valuation
Ugh.
rationalization, interest rate change, it shook you to your core of your career, Chrissy. Come on.
I I'll give you the like plus side of this. I do think for the smaller specialized venture funds, actually healthcare is a great place to invest because we do see a lot of M&A and we do see
Yeah.
a lot of great outcomes in that kind of like 50 to $500 million category. You can definitely return money. It's really where I have questions, Stephanie, is 10 billion plus. Because
Yeah.
if I'm in fintech and I said, you know, if you said to me name 5, 10 billion plus outcomes, I could come up with a list. If you said the same question to a health tech investor, I think that list would be very small. I don't even know who's on that list. Maybe you
Nuance,
know, but
right? Well, look,
yes.
here's what I would say. So I bet my career on it, right? Like I fundamentally believe that greater technology in healthcare is necessary and will happen over time. And when I originally was looking at the sector and debating moving over from fintech and payments into healthcare, my thought was that the penetration of tech within payments and fintech and banking, it had gone from very little to a lot during the time that I was doing more of the IT services payment side of the world. And healthcare was still at a very little, and I assumed it would have to go to a lot in penetration. Now, why haven't you found better outcomes? Well, part of it is the acquisition trajectory, right? I think if you have a very successful health tech asset, you also have larger assets like a United who will say, you know what, I might as well just own that. If that is the future of healthcare, I would like to be a part of it. And then you don't include United in the health tech index. And so it looks like a relative underperformer. So the
And
assets that are
United
left are
isn't
often,
isn't buying right now too, which is I think
right?
part of the issue.
But it's like it's if you look at the broader trajectory, like the good health tech assets, that health tech assets that really outperformed have tended to get bought, right? Like what happened to all of the EHRs? Those had the best returns when I looked at the historical kind of trajectory of health tech. They all got acquired. They're either owned by a large tech company or private equity at this point. So you're kind of seeing like the future of healthcare. Like eventually, if you succeed so much, you are so much the future of healthcare that someone wants to buy you and own you. And that's kind of why the public health tech assets look bad. It's not that there's any sort of fundamental reason where healthcare wouldn't have more tech in it or more tech enablement, right?
Yeah.
Like it's that the really good stuff gets bought by even bigger companies, which isn't a wrong thing. It's not bad. Like nuances in Microsoft, that's a great outcome.
Yeah, I think that's true. We do see a lot more acquisition appetite in this space, and IPOs are far and few between, although that
Yeah.
likely could change in the next couple of years. Stephanie, we got a bunch more questions trickling in.
Well, let's answer them. I will
Rayhan,
say, like in the public market side, I spent a lot of time with merger arb people, which meant there were a lot of deals. Spent a lot of time with them.
and awesome. Okay, we've got one here from Rayhan, who asks, has time to 100 million ARR expectations shifted in the last 3 to 4 years versus pre-COVID? And with AI native companies or AI enabled SaaS tech enabled services growing quickly, do we see exit timelines shrinking? Stephanie, any thoughts?
I also always thought that time to 100 million ARR was kind of a silly metric because your trajectory from $0 to $10 is very different than your trajectory from like that 10 or 50 to 100. And the trajectory from 100 to 300 is like a massively different thing. Uh, you could very easily be 100 million ARR run rate company and kind of just mature at that versus kind of having this path to like owning a larger portion of healthcare via like an EHR or something. Um, so I thought it was kind of silly as like a metric that we used for like taking a company public, always just like fundamentally. I do think that, in an easy money environment, obviously the path there is a lot faster than a tough money environment. That's just natural. You might see a few disruptive areas like Gen AI that changes that. But yeah, I wouldn't
Yeah,
peg my future based on the path there. I would instead based on what the path is forward from there.
I also think 100 million now seems really low. Most of the companies that I'm
Yeah.
aware of that haven't gone public yet that folks think will go public are at way higher revenue
Well, the
than that.
bar has changed, right? It's because of the interest rate environment. We're in a low interest rate environment, 100 million of revenues and, break even EBITDA, or at least line of sight to break even EBITDA, that could go out. Rates are different. And so now it's, what's come public really successfully. Could you be $1 billion of revenue and have like double digit EBITDA? Yeah, that's a pretty easy sell. Um, don't forget, I think people like forget this. They think of an IPO as the finish line. An IPO is just a transition into kind of being in your reality TV stage of your life, where now you have to go and have this quarterly reporting, you have to deal with investors, but whims change. There have been times where some of the boring names have been my favorite picks. There have been times when some of the growthy names have been my favorite picks.
Can you name one of those times for each?
Oh my God. Yeah. I mean, in a zero interest rate environment, I was a really big fan of Teladoc. It was my top pick for years, right? Low interest rates, super growthy. I fundamentally believed in the idea that telemedicine would be a bigger part of healthcare, and like it is. Not to toot my own horn, but like it got there. So that was a time when I loved telemedicine when I was still developing. Then rates went up and skyrocketed, and all of a sudden, like next gen looked pretty good. Next gen didn't look bad at all. It
And
was stable, it was
how do you
steady, it was
factor in
profitable, it was a real business.
Teladoc's acquisitions too? I mean, like
A lot of them
the
were good. We give them flack because of Livongo, but let's not forget that BetterHelp, which is by the way $1 billion revenue run rate business, like nothing to scoff at. $1 billion. They acquired it for what, like I think single to double digit millions.
and I think there's a world where Livongo could have been a better story for them too. A lot of that was just like
Yeah.
the post-merger integration and just very different kind of cultures. So
Yes.
that's a really interesting point. So at one point you were very bullish on Teladoc. Then you said you moved into next gen. What are you most bullish on now?
I'm not a covering analyst right now, Chrissy, but if I had to really say like what's in my PA right now, some of the new digital health entrants, right? Like I think Omada is a fantastic story. I haven't really seen the stock trade up to where it first came public. I don't think the trajectory is wrong. Having met the management team a bunch, I think they have a trajectory where a beat and raise is very possible. That's an excellent asset to have. Doximity is also, it's a big part of my portfolio.
Yeah, I agree on
I
Doximity.
that's
I think it's
it's a
super
great
interesting.
business. It's a great asset. I think you're going to see more dollars going into advertising for pharma. And last one that I've been looking at recently, I actually just recently got involved in, Frisia. Um, they've had a big gap down because of the M&A that they've had, but payments is a real business in healthcare. And I think if anything, I'd bet on more payments digitization than not, with a little bit of the kind of network side where they have some advertising. So yeah,
Okay,
there's opportunity in health tech. Let's not hate on the
I'm writing
sector.
all this down. Now that I'm actually allowed to like, you know, trade stocks, which I didn't used to
Yeah,
be for
me
years.
too,
So
right?
fun. All this newfound freedom. So we had another question come in from Anne about women's health. I'm going to put you on the spot just for fun.
Ah, let's hear it.
Who goes public first, or gets acquired, or
Hmm.
like who do you bet is the first women's health IPO? Do you think it is MIDI? Do you think it is Maven? Do you have a different bet that I haven't thought of? What do you think is the first and why?
I think Maven's going to be first because I think there's a lot of demand for a solution like that. Like I think Progeny is a great asset where maybe there's some concerns about management team track record. Maven could really solve for that. And I think what they've done a great job of and what Progeny hasn't done a great job of is breaking out of purely the commercial market and showing that they have real cost savings. Otherwise, the government wouldn't be reimbursing for it or actually using it at all. Um, that's one I've been waiting to go public. I've been surprised that they haven't. MIDI, I think, is a huge opportunity, right? Menopause care is very hot right now. I think they just need to scale up. And if I were them, I would be getting out to some of these investor events and kind of telling the story in a bigger way now.
Yeah, and I think both those companies have really compelling CEOs. You know, Joanna and
Yes,
Kate, both extremely compelling, and
exceptional.
I really think both of them could tell an incredible story. And they both have, by the way, investor backgrounds. They both have worked at VC firms. So I think they will
Agreed.
be great.
They're in on the joke. They get it. I think they're
They
going to be
get it. They'll
great
be
at
great.
messaging.
Yeah, exactly. We got a kind of existential question in
Ooh,
from
I like those.
Kate Sullivan Morgan. I love this question, and it's one I think about all the time. Stephanie, you made a great point about consolidation. Many new entrants start out thinking about themselves as disruptors, but then they realize that to be commercially viable, they need to play ball with traditional players, basically enabling them in the path to getting acquired by them, as in the example you gave with UHC. So, do you think we'll see any IPOs of actually truly disruptive companies?
Ooh, good existential question. Well, look, like I think this is kind of a fundamental issue in health tech. There's a lot of technology companies that try to go in healthcare, right? Google is a great example of that. And they always go, hey, we're going to disrupt this. It's such a slow moving market. And then they realize that you have to play ball with the incumbents. You have to. It makes a lot of sense too. And like, there's a reason that these are large players that carry a lot of like weight with a patient and a lot of dollars in their volume. So you can never truly fully disrupt. I think, telemedicine was disruptive, but it also ended up being a vendor to providers. So let's not forget that. True disruptors, the market is so ready for PBM disruption.
Oh yeah. We were like
Yeah.
jamming a little bit on text about like the next interesting IPO, I think the other day, and both of us said Capital RX. Like we both said
Yeah.
it basically at the same time. And I think it's because we've both been thinking about the PBM disruption opportunity. And
Well,
I keep hearing that
PBMs,
that company's
they
doing
were
well.
they were such a core holding for the longest time, PBMs and like kind of the health tech and services world. And they were acquired, as most good assets are. And then we haven't really been able to invest in that in a pure play way. So I think someone coming and disrupting the PBMs, especially at a time where, you know, GLP-1s and a lot of more expensive specialty drugs are starting to create some need for that disruption and finding a way to publicly invest in that, like I could see a lot of investors loving that.
100%. And if you can crack the jumbo employer, I think that's where like things
Yes.
really start because nobody wants to be a first mover, but they all want to be the second mover, which is really
Yeah.
where the opportunity is, and you kind of see this domino effect. So another question we've just had coming in from Sherman Sanchez, who asks, "What if anything in the aging space and this silver tsunami?" Which I think is a really great point. We have this aging population. I haven't seen too many companies really address that. I think Best Buy Health
No.
wasn't a big success story.
Tabula
Um,
rasa, right? They did a lot with PACE, but I think it was unfortunately too early because PACE programs hadn't been broadly adopted as much as they even now should be. Um, One of the biggest issues I think investing in the whole longevity component of this is that a lot of times when you see disruptive companies come in and have this interesting trajectory, it's because employers started to invest in them and actually use them very early. I think about like first consumers tend to use a product. So if you have like a D2C start, like there's nothing wrong with that. It's just staying in D2C longer term. That's where things go poorly. Then employers adopt it, then payers, and then providers adopt solutions. Like that's kind of the trajectory of a lot of health tech. And along kind of the aging plays, you kind of have to have government adopt it first, which is the slowest moving. And that's probably why we haven't seen a ton of that disruption. I wish one would come out. I'm here. I'm
yeah,
waiting. I'd love to see it.
me too. And you just made a point about D2C in the long run, because we do have a bunch of companies in the private markets that have raised gobs of money, like Row, that have not
Yes.
gone out. And I think, Noom is not purely consumer at this point, but has a really interesting story to tell around GLP-1s. Are there any trends in the market like that as a potential example that could make some of these more D2C companies successful in the public markets?
I mean, I do think Hims has been a volatile stock and a meme stock at times. But the pitch I've always heard is it's un-American to try to short something that helps with regaining hair, weight loss, and ED, right?
Un-American, that's amazing.
Un-American. Chrissy, I can say this to you given your accent. Fundamentally un-American.
American
USA.
men deserve hair, and we should pay for that. I love it.
But it's a D2C thing. Like that's a D2C play that has a lot of legs, right? Like all these vanity scripts. Um, I think where things go wrong, the kind of virtual mental health solutions, it's great to start in D2C. You get a lot of adoption, but if you get such critical mass of adoption, you may see payers get pressured to reimburse for it. And once payers did reimburse for it, surprise, surprise, consumers prefer when they're not paying out of their pocket and their payers paying for it. So you just need to be nimble and able to evolve. Roe, in that context, should be able to come public and have a successful run. And I'm a big fan of the management team, right? I think Z is fantastic.
Me too.
Noom, I would be a little worried about some of the comps because I think GLP-1s, there's this fear that it's going to be kind of a near-term pain point. Eventually get more GLP-1 competition on the pharma side and you get a race to the bottom when it comes to pricing. That's usually what happens. And maybe we won't need as many solutions for that then. Also, the comp set is kind of rough. Weight Watchers, I'm an eternal bear on that stock.
So many questions about that, but we only have a few more minutes and a bunch of questions that have come through.
Let's answer the questions.
So
and people, if there are more questions after, folks can feel free to go and ping either. I'm so happy to answer.
We'll keep answering them on LinkedIn.
Yeah.
Pat asked a question about D2C perspective. So I think Pat, you and I are a kismet because I just asked that question. Stephanie, we've had a question around Google, Apple, Amazon, all these big tech companies. Why haven't they had as much success in healthcare as they perhaps should have, given the deep pockets? I might actually answer this one for
answer it. I want to hear your perspective.
So I covered these companies in the march into healthcare, and I think a lot of the problem is that healthcare is the customer in many cases. Like if you sell cloud, healthcare is who you sell cloud to. And it's a fear of, between these various teams of not disrupting kind of to be way lower margin than excited about Amazon and continuing to be excited about Amazon because they are not afraid of a low margin business opportunity.
Burning cash is not a big deal.
Not a big deal. And they have had the most ambitious strategy, I would say, of all the big tech companies. I think that's the historical perspective. Any future perspective, Stephanie, maybe AI is a bigger opportunity for them, or is this just going to kind of go the way that cloud did?
Well, honestly, I see the AI arms race. They're better being a vendor to all of these different health tech players than going into it themselves, right? So I think it's going to be a little bit more like what you said with cloud. When I think about why the big tech companies haven't done as well, some of it's disruption, some of it's finding their own niche. So maybe we as consumers don't see it as much. At its core, Amazon's business model is a consumer-facing company, so we should be seeing them the most. That's why their M&A in the space has been the most consumer-facing in that, right? Like the One Medicals of the world and them going to Amazon Pharmacy. I think that's very interesting, and I hope they keep it as a longer-term project versus one of their little flash-in-the-pan experiments, because there's a huge opportunity to go and save consumers a lot of money. How does Microsoft make money? Microsoft makes money by selling software to a lot of folks in cloud, right? Software and cloud. So like Nuance is great for them. I think they're going to be selling more of that software into a lot of different hospitals, but are they going to try to disrupt revenue cycle management versus maybe having OpenAI sell some of their solutions into revenue cycle management? Yeah, I'd probably say the more profitable route is the latter versus the former. I think selling cloud solutions is a very profitable way to do that. So that's probably how they're going to make money. Google at its core, it's cloud and its advertising revenues, right? So that doesn't lend itself into healthcare as much unless you want to get into the pharma side more, and they haven't done that. So that's kind of, you have to think about the DNA, the core DNA of a lot of these tech companies and how they want to go and approach it.
Yeah, I once had somebody from one of the big techs say to me, like, you look at healthcare, where are the opportunities that are truly big enough for a tech company to care, given how much money they make? And you literally have to like become a payer, or you have to build a health system or several. And that just takes a ton of internal buy-in, which I think that's been the challenge. So
there's also an ick factor. Remember when Google they were just trying to help on the kind of the side of data analytics for some health centers, and people didn't like that.
Yeah.
I don't want Google doing my healthcare stuff. I want them giving me better ads for clothing so I don't have to have a personal shopper.
There's definitely liability there. I'm going to ask a last question before we wrap. Actually inspired by Ariel's question. She asked about mistakes that companies make that you've seen as they go public. And I maybe want to add on a little context to this question. That I recently was talking to a fantastic communications executive in the space, John Halleck, who's been through
Love them.
Livongo and
Excellent.
several other companies going public. And he said to me, companies equate being conservative with the financials, which you have to be today, with being
Yep.
conservative with the message. And I think that's 100% spot on, because I see a lot of companies now being really conservative with the story as they consider an IPO. And yet, to your point of like, who's going to get acquired, it's probably the potential disruptor. So if you don't make some noise about how disruptive you are, then you'll be seen as just kind of one of these boring kind of grease the wheel companies that just, isn't fundamentally doing anything different. So to me, I think you still need to be, while you can be conservative with the financials, you should be spicy, a little bit more spicy, a little bit more risk tolerant with the message. Any thoughts from you, Stephanie, before we close this one out?
You quite literally wrote the book on this. And if folks haven't checked this book out, Chrissy, she wrote a fantastic book on this. I've told this to a lot of like financial sponsors, VCs, PE. Getting the story right when you come public is probably 80% of the battle. Like a shockingly large part of the battle is not just making sure, you're putting your numbers out there and you're hitting your numbers, you're beating your numbers. It's making sure investors know who you are, what you want to be as you continue to evolve with these public market dollars, and kind of what the true potential is in the space. And, if you think, no offense to some of my prior colleagues, if you think the research analyst is going to be able to do that for you, a lot, like the majority are just regurgitating what you're saying in the investor day. So make sure you have the right spin, make sure you have the right message. Otherwise, like, don't go public. It's not the right market for you.
I will say I did really like the Hinge IPO prospectus. Like I even got design inspiration from it. It was very well done. So even just thinking through the like routine, boring documentation, and trying to find your own way to get some personality in it. I think that's really key as well. And maybe look at some examples from the past, like, Google had a brilliant one. So with that, I will thank you,
But even
Stephanie.
the spin, like we're earlier in our growth trajectory. Don't compass the existing digital health now. I was
I love that. That's such a good idea.
At how the companies use that. Like, oh my gosh.
Yeah, I think that's a great one. Put that in the very front of it. And I've seen,
100%.
big tech, Google. The reason I love that was they literally were like, if you're not an investor that's like aligned to, the long-term vision of this business, even if it means there are certain revenue opportunities we don't take, then like goodbye, see ya. And like that's great. That gives people FOMO. I mean, I think you got to play the psychology.
You got to play the psychology. You can't just say like, a lot of times I see companies trying to fix this by going like, we're not a health tech company. Maybe we're a pharma company. Maybe we're a software company. Maybe we're a payments company. Like, you really think you're going to lie to the market? You're not trying to convince 5 VCs in order to go do your next round. You're trying to convince every person who has public market dollar. Like, you're not going to succeed in lying about your business model. Reframe your comps. You can say, hey, this is the different trajectory. This is a different time period. We're in a different part of our life cycle. Do that. Like, my goodness. Or if you can't figure it out, call me.
Just tell the truth. Just tell the truth. I love it. Stephanie, we've gone a little bit over than I promised you we would end 5 minutes ago, but
I always have time for you,
talking to you. And I love how many comments we got on this, and I'm apologies that we didn't address all of them, but I promise we will go back through and answer them and really just have a great weekend, guys. Thanks for joining us.
Hey, always space for a point too, right?
Love it. All right. Bye, guys.